The Boglehead's 3-fund portfolio is probably the most popular lazy portfolio out there. In this video, we'll take an in-depth look at what it is, why you'd want to use it, its historical performance, and how to build it with low-cost index funds. Don't worry if you're starting from scratch and have no prior investing knowledge. By the end of this video, you'll feel confident knowing exactly how to construct a globally diversified investment portfolio that you can hold for decades to build wealth. So what is the Boglehead's 3-fund portfolio? The Boglehead's 3-fund portfolio is arguably the most popular lazy portfolio, which just means a portfolio that you don't need to constantly monitor or change. Bogleheads are followers of the sage advice of the famous Jack Bogle, founder of Vanguard and considered the father of index investing. I am one. The Boglehead philosophy and approach is as follows. Develop a workable plan, invest early and often, don't bear too much or too little risk, diversify, don't try to time the market, use index funds whenever possible, keep costs low, minimize taxes, invest with simplicity, and stay the course. The Boglehead's 3-fund portfolio, as the name implies, is a simple portfolio comprised of 3 broad index funds: a total US stock market index fund, a total international stock market index fund, and a total US bond market index fund. The Boglehead's 3-fund portfolio draws on the idea of portfolio diversification's ability to reduce volatility and drawdowns, protect against black swan events, and maximize risk-adjusted return. Holding multiple uncorrelated assets invariably reduces risk and can result in higher returns, and almost always higher risk-adjusted returns than holding one asset in isolation. We'll go over these specific assets and talk about those correlations later on. This portfolio utilizes broad low-cost index funds that hold a basket of investments in one vehicle. These funds track an index such as the total US stock market, comprised of over 3,000 stocks, as opposed to stock picking and active selection of a handful of investments. Jack Bogle advocated for simply buying the whole haystack instead of trying to find the needle. Consider these facts. The evidence has shown that even most professional investors can't pick winners that beat the market over 10+ years, much less the average retail investor like you and me. On the 50th birthday of the S&P 500 index, only 86 of the original 500 companies remain. Blindfolded monkeys randomly throwing darts for stock picks have beaten top hedge fund managers not just once, but consistently. Most stocks underperform the market. Only a select few drive massive returns. Specifically for US stocks from 1926 through 2017, in terms of lifetime dollar wealth creation, only 4% of stocks accounted for the net gain above T-bills. Looking at global stock returns from 1990 through 2018, only 1.3% of stocks accounted for the positive wealth creation in excess of T-bills. In short, we should reliably expect to see the empirical results we've observed historically, that stock picking strategies, especially those that are poorly diversified, tend to underperform the market. Somewhat ironically, simply buying index funds like we're doing here involves much less time and effort than active stock picking and trading. Even sector bets, such as overweighting categories like tech or healthcare, are usually not a prudent move, as they're just stock picking light. Betting on sectors increases uncompensated risk, additional risk without an increase in expected return. In doing so, investors increase their chances of underperforming the market. Just like with individual stocks, some sectors will outperform and some will underperform the market. How do we know which ones will do which, and during what time periods? What about different economic cycles? Tech has had a huge run recently. Will it continue? In short, no one knows. Diversification seems to be the only free lunch with investing. This is why broad index funds like the S&P 500 and total stock market are recommended so often. Specifically, using total market index funds, one can be fully diversified across every sector, style, and cap size, in this case both domestically and abroad. You can brag to your friends that you own over 10,000 stocks in your portfolio. You get exposure to the success of any sector and any stock at any given time in a market index fund, while eliminating sector risk and single company risk. Index funds are also self-cleansing in that growing companies rise within the fund and bad companies drop off. Bogle suggested the majesty of simplicity. The simplicity of the 3-fund portfolio is underrated. This simplicity in the use of total market index funds allows investors to not have to worry about choosing the correct asset styles and cap sizes, much less the correct sectors and individual stocks. Buying the market guarantees market returns. Using narrower funds with the goal of market outperformance, usually as a result of recency bias and performance chasing, creates complexity and the potential for market underperformance, and subsequent uncertainty and tracking error regret, especially for novice investors. This can lead to abandoning one's strategy altogether, usually at precisely the worst time. It is imperative that investors have strong conviction in their strategy in order to stay the course. Index index funds make that much easier. Taylor Larimore, considered king of the Bogleheads and co-author of the Bogleheads Guide to Investing and the Bogleheads Guide to the 3-Fund Portfolio, succinctly summarizes the benefits of the strategy as follows, in no particular order. No advisor risks such as incompetence or conflict of interest. These invariably lower your returns through market underperformance and or greater fees. No asset bloat, meaning new money entering a managed fund that impacts prices and lowers expected returns. Total market index funds can easily spread new money among thousands of stocks. No index front running, meaning traders preemptively buying or selling securities before they're included or excluded in the index. Owning the total market means we're not exposed to that impact. No fund manager risk, such as a manager leaving an active fund which changes its future performance. Index funds don't pick individual stocks. On that note, no individual stock risk. Picking individual stocks notoriously underperforms the market over the long term. We'll touch on some stats related to this later in the video. No overlap. The 3 funds in this portfolio have zero overlap, so we're avoiding concentration and maximizing diversification. No sector risk. Sector picking is just stock picking light and is a source of uncompensated risk. A total market index fund already gets us exposure to every sector. No style drift, which refers to a fund's divergence from its stated investment focus, such as for something like a mid-cap value fund that hones in on a narrow subsection of the market. Since we're buying the total market here, we don't have to worry about style drift. Low tracking error. Tracking error refers to the difference between the fund's true value and its underlying index it's attempting to track. These types of funds we're using here famously have the lowest tracking error in the investable universe. Above average return, ensured by the fact that most active investors must necessarily lag the market after fees, taxes, and trading costs, as the market return is just the average of all investors. There's also a plethora of academic studies showing that most active managers underperform the market over the long term. Simplified contributions and withdrawals because we only have 3 funds. Increasing that number means more time and effort spent depositing or withdrawing across them. Consistency. For narrower index funds and actively managed funds, things like the manager, selection methodology, style, and risk profile change more often than you might suspect. We don't have to worry about these things because again, we're simply buying the total market. Low turnover. Turnover refers to how much trading a fund is doing to replace its securities periodically. Higher turnover means more costs in the form of commissions, spreads, administrative costs, and taxes. Total market index funds have the lowest turnover. Low costs. Fees are the best predictor of fund and portfolio returns because it's one of the few things investors can control. Total market index funds, and specifically those from Vanguard, typically have the lowest fees in the game. Maximum diversification. Diversification is said to be the only free lunch in investing. The 3-fund portfolio diversifies globally across multiple asset classes, which means lower risk for the investor. Portfolio efficiency, which refers to the ratio of risk to return. Basically, total market index funds tend to offer the highest return for any given level of risk. Low maintenance. In many cases, portfolio maintenance increases in direct proportion to the number of funds used. Keeping things simple here saves us time and effort in the future when it comes time to rebalance or withdraw. Easy to rebalance. Rebalancing refers to periodically bringing the portfolio back to one's target asset allocation after that allocation shifts over time. For example, if stocks go up and bonds go down, our initial portfolio percentage breakdown has now shifted. So we want to sell some stocks and buy some bonds to bring things back into balance. This only needs to be done about once a year or every couple years. Having fewer funds makes this easier to do. Tax efficiency. Index funds are among the most tax efficient investment products because again, they have lower turnover and thus produce fewer taxable capital gains distributions. This is true for both the fund manager and the investor herself. Remember that we're always concerned with after-tax return. Simplicity, which is vastly underappreciated by most investors. This appreciation comes with experience. By simplifying your investments, you have more time for family and activities and other more fulfilling pursuits than portfolio management. Arguably the best hidden benefit of this simplicity is that it cuts down on the investor's psychological stress and tracking error regret and thus makes it easier for the investor to stay the course. Another quote from Jack Bogle on this point is that simplicity is the master key to financial success. Now let's explore the selection of specific assets and corresponding funds. Stocks have the greatest expected returns of any asset. Owning shares of a company's stock gives you partial ownership and participation in its future earnings. The US stock market makes up a little over half of the global stock market by weight. Vanguard's ETF for the total stock market with over 3,000 stocks is VTI. The mutual fund equivalent that you may find in your 401k menu is VTSAX or VTSAX. International stocks don't move move in perfect lockstep with US stocks, offering a diversification benefit. If US stocks are declining, international stocks may be doing well, and vice versa. If you're watching this, chances are you're in the US. You also probably overweight or only have exposure to US stocks. This is called home country bias. The US is one single country out of many in the world. By solely investing in one country's stocks, the portfolio becomes dangerously exposed to the potential detrimental impact of that country's political and economic risks. If you are employed in the US, it's likely that your human capital is highly correlated with the latter. Holding stocks globally diversifies these risks and thus mitigates their potential impact. No single country consistently outperforms all the others in the world. US outperformance is a very recent phenomenon. The legendary Meb Faber found that if you look at the past 70 years, the US stock market has outperformed foreign stocks by 1% per year, but all of that outperformance has come after 2009. There have been extended periods where a global portfolio beat a US portfolio, such as from 1970 to 2008. Notice how US or international outperformance tends to be cyclical. If I were making this video in 2010 or 1990 or 1980, we'd be talking about how a global portfolio beat a US portfolio the previous decade. The important takeaway is that it's impossible to know when the performance pendulum will swing and for how long, much less how those time periods would match up with your personal time horizon and retirement date. And for those who like to claim that many top US companies get sales from around the world, so we don't need international stocks, the premise and the conclusion both miss the mark. First, stocks tend to move with their country of domicile. Coca-Cola is going to behave like a US stock at the end of the day, regardless of the fact that its sales are global in scope. Secondly, we care about the imperfect correlation of stock markets, and the stock market is not the economy. Global sales exposure for multinational US firms does not provide meaningful diversification. Lastly, we're concerned with extended bear markets and black swans that could derail our retirement plans, and the US is not somehow immune to those. Consider the famous lost decade of 2000 to 2009 as an example to illustrate this point. While US stocks finished the period down 10%, international stocks were up 25%. In short, geographic diversification in equities has huge potential upside and little downside for investors. I went into the merits of international diversification in even more detail in a separate video here if you're interested. For the allocation to international stocks, we can use a total international stock market fund like Vanguard's VXUS. This ETF covers both ex-US developed markets and emerging markets at their global market weights. The mutual fund equivalent here is VTIAX. Bonds tend to be the go-to diversifier of choice to hold alongside stocks because they typically have the lowest correlation to stocks of any asset. That means when stocks zig, bonds tend to zag. There have even been extended periods where bonds beat the stock market, such as for the 20-year period of 2000 to 2020. The bonds allocation is the piece that is most responsible for adjusting the risk level of the portfolio. We'll show that risk reduction in action in a little bit. Most investors also overestimate their tolerance for risk and do not have the stomach for 100% stocks. Here we're using the total US bond market, for which Vanguard's ETF is BND. Its mutual fund equivalent is VBTLX. What about international bonds? The inclusion of international bonds in diversified portfolios and target date funds is a fairly recent occurrence. Until recently, costs of international bond fund products were prohibitive for retail investors, and international assets of all kinds were viewed with skepticism until about the 1990s. Vanguard didn't begin including international bonds in their target date funds until 2013. The evidence seems to show that international bonds may offer a small diversification benefit in terms of credit risk on the fixed income side, but there's no compelling reason to think it's any significant benefit. This potential diversification benefit is even less convincing for a portfolio that is not bond heavy. Vanguard published another paper in 2018 that showed that for a 60-40 portfolio during the period 1985 to 2013, diversifying internationally with bonds resulted in a reduction of volatility as measured by standard deviation from 9.5 to 9.4, a reduction of 1%. In short, there's no good reason to consciously avoid international bonds, but there's also no good reason to embrace them either. It's unlikely to help your portfolio and it's unlikely to hurt it. Bogle suggested that when there are multiple solutions to a problem, choose the simplest one. Samuel Lee agrees, suggesting that utilizing international bonds appears to be a case of diversification for the sake of diversification. If you still do want to incorporate international bonds, don't worry, that's just the Bogleheads 4-fund portfolio. Now let's talk about the historical performance of the Bogleheads 3-fund portfolio. Here's a visualization of an 80-20 allocation. We'll go over what that means shortly for the period 1987 through June 2023, with a starting balance of $10,000 and $500 invested monthly adjusted for for inflation. Over that 35-year period, you would have ended up with a final balance right under $2 million, illustrating the power of simplicity, consistency, and compound returns. That's a time-weighted rate of return of about 8.7%. I mentioned earlier that diversification decreases the risk of the portfolio. Here we're looking at stock market crashes when the value of the portfolio drops suddenly and significantly, which we call drawdowns, for the US stock market compared to our 3-fund portfolio we've been discussing. Notice how these valleys are smaller for the 3-fund, represented by the red line. Interestingly, the Bogleheads 3-fund portfolio does not have a specific one-size-fits-all prescription for asset allocation, meaning the ratio of the different assets. The investor is encouraged to choose their own based on time horizon and tolerance for risk. Assuming a retirement age of 60, a general rule of thumb is to use age minus 20 for bond allocation, obviously titrating up or down based on risk tolerance. Vanguard has a useful quiz to help you choose that I'll link to in the description. They also have a page showing the risk-return profiles of different allocations historically. Given that, for the sake of simplicity in this video, let's assume a starting age of 20 and a retirement age of 60, yielding an average investor age of 40. Many investors like to overweight US stocks. Jack Bogle himself suggested a maximum of 20% in international stocks, and a Vanguard study suggested a minimum of 20% to get any reasonable diversification benefit. A compromise between those would be 20% in international stocks. Based on those parameters, putting it all together, a one-size-fits-most 80-20 allocation for the Bogleheads 3-fund portfolio is as follows: 60% total US stock market, 20% total international stock market, and 20% total US bond market. Using our funds mentioned earlier, that means 60% VTI, 20% VXUS, and 20% BND. I'll include a link in the description to invest in this portfolio with just a few clicks. While it may seem counterintuitive, hopefully now you can appreciate that by investing in 3 simple, broad, low-cost index funds, you are likely to outperform most other investors, including professional traders and managers sitting in front of a screen all day, every day, analyzing stocks. As a US investor, you may still feel slightly hesitant about international stocks. Click here to watch my more thorough video explaining why global diversification for US investors is a sensible idea. What do you think of the Bogleheads 3-fund portfolio? Let me know in the comments. Thanks for watching.